Good morning, everyone. Well, this video may be out of date by the time you see it because the situation in Ukraine is changing so quickly. It now appears that Russia's President Putin has ordered Russian troops on exercises near Ukraine to return to their barracks, which would be a good sign that pressure is being ratcheted down. Whether that's due to a desire to prevent the situation from escalating or whether it's because they've already achieved their goal of intimidating the Ukrainians, I don't know. We'll have to wait to see how it plays out. Personally, I don't think things like this end so simply and easily. I think even if they have returned to their barracks, the Russian presence in Crimea is likely to continue, which will provide plenty of disruptions in the future. At the same time, though, you have to admit that soldiers in their barracks are much less likely to shoot someone than soldiers walking around the streets. So this move is a welcome reduction in tensions, and it's natural that gold should be falling and gold should be falling and euro-dollar should move higher. Given how rapidly things are changing there, I'm not going to go into so much detail today. I just want to point out two anomalies that we saw in the market yesterday. First off, despite the strong risk aversion trade, dollar yen and dollar Swissy both moved higher. Dollar yen was boosted by comments from Bank of Japan Governor Kuroda that there's momentum spurring the yen carry trade. Now, it could be that he said this because the Japanese authorities are getting uncomfortable as dollar yen approaches 100 again, and he wants to ensure that it stays above that level. As for the Swiss franc, it's surprising that the currency isn't gaining, but if you look back at what happened when Russia went into Georgia in 2008, the Swissy didn't gain then either. So actually, it isn't so surprising. The ruble was fairly steady after the central bank hiked interest rates temporarily by 1.5 percentage points yesterday and intervened heavily in the FX market. The other Eastern European currencies, however, lost even more than the ruble, such as the Polish zloty and Hungarian forint. There's no doubt that some contagion as investors pull out of Eastern European equity funds and emerging market equity funds in general, hitting other smaller markets as well as Russia. This, too, is consistent with what happened in 2008 when the other Eastern European currencies fell by more than the ruble. They should rebound eventually, in my opinion, as the decline isn't due to any inherent problem of theirs, but for now, they're hostage to events outside their control. For the rest of the day, there really aren't any market-moving indicators out, so investors will just be watching the news from Ukraine and Russia and trying to make sense out of developments there. For more information, including technical analysis, please read the full comment on IronFX.com. You can also follow us on Twitter, like us on Facebook, subscribe to our YouTube channel, or circle us on Google+ to get more trading ideas. This is Marshall Gittler, Global Head of FX Strategy at IronFX Global, wishing you solid trading.